Welcome everyone to Vested Interest. This is Shane back for a stock pick of the day video. We are going to take a look at another new recent addition to the Berkshire Hathaway portfolio. Nucor Steel is out of the industrial sector. This is the vested interest stock screener. This is the criteria, excuse me, we will be running through today in this video. It must make 5 of 8 to make it onto my watch list. And if it does make it on my watch list, just keep in mind that does not necessarily mean I am buying. It just means I'm interested in doing more of a deep dive into the financials of the company, looking at the balance sheet, their income statement, looking at their debt to equity ratios, their revenue, or their margins expanding, things like that. Then doing a discounted cash flow analysis, seeing a range I'm willing to pay for the company, and then possibly adding it in the future if I'm adding new positions and it makes sense. Now you can check them out on their homepage, nucor.com. That's nucor.com, where I pulled this information from. Who we are: Nucor is North America's most diversified and sustainable steel and steel products company. Our team is forged around a vision for leading our industry by providing unparalleled customer care, building trusted partnerships, and creating sustained value. So they would be providing the steel for buildings, cars, other things that make or need steel for the process, manufacturing process out there, or building processes out there. Now, the reason we were taking a look at them, down 1.67%, and as I mentioned, they are a recent addition to the Berkshire Hathaway portfolio, so I thought we would take a look at them on the day that they were down. Nucor Corporation, ticker NUE, that's who we're talking about. Close out the day at $143.47. 52-week range as low as $97.59, as high as $170.52. They are not close to their 52-week low yet. They're within 50% anyway. Need to drop below $112 and some change there to be there. So they are really tilted more towards their 52-week high right now. A market cap of $32.931 billion, a beta of 1.75, so they are more volatile than the overall market, quite a bit more volatile actually. So maybe you can use that volatility to your advantage if you're interested in this company, waiting for a big pullback and then holding on the run-ups. PE price earnings, $25.87 per share, seems a little high for a company like this. Now, I know some people have said maybe the reason Berkshire Hathaway, Buffett there added it to their portfolio is because of the recent tariffs that they put on, which are around, I think, 50% for some companies. So maybe that helps the steel companies out. I don't know. They've had those type of tariffs, not to that extent, but they've had tariffs on steel for decades, as long as I can remember, really. China was dumping steel into America for a while, so they started with tariffs, and they've notched them up over the years on countries, and all the reasons have always been to bring steel manufacturing back to America, and every year the steel manufacturing seems to get worse and worse. I think we just recently had a company that was sold off to a foreign entity under Trump as well. So I don't necessarily buy that it's going to bring manufacturing back. Tariffs don't necessarily do that. They just increase costs. In my mind, that's what I've seen over the decades, so that's what I'm going to go with until they can prove otherwise. But that is a reason that some people have mentioned as a reason why this one was added to Berkshire Hathaway's portfolio. Earnings per share, EPS, $5.57 per share. Earnings date, October 27th, so a couple months away from that. Forward dividend is $2.20. They are a quarterly payer, I believe. We'll see that here towards the end of the video, with a current starting dividend yield of 1.51%. Ex-dividend date, June 30th, so we are past that. Looks like they paid out on August 11th, so we're past that date as well. So if you were to buy them now, you're going to get the next dividend, but you're going to have to wait a few months to get it. 1 year target estimate, $154.99, so they don't see it getting back to its 52-week high. Actually, not much higher than it is right now. 170.52 being, what is that, $16, $15 and some change away from their 52-week high, so not quite back to that 52-week high. Payout ratio is at 39.25%, so it is under the 75% that I look for. I also like to look at dividend yield theory. To do that, we look at their 5-year dividend yield average, 1.66%. We compare that to their current, 1.51%. Since it is lower than their 5-year average, their current is lower, 151 is lower than 1.66, it speaks to overvaluation, at least according to dividend yield theory. Now, looking at free cash flow growth, I want growing free cash flow because a company, they can do some things with that free cash flow. They can pay down debt, make acquisitions, reinvest back into the company, building out that manufacturing base if they need to, buy back shares, pay a dividend, which this company does, and raise that dividend over time. Keep some of that cash on the balance sheet as cash for a rainy day if they want as well. And we want a company to be able to do all of that which with a payout ratio at 39.25%, it's pretty safe. Doesn't look like they're in danger of a dividend cut anyway. But looking at their free cash flow, going back to December 2022, 8.1 billion in free cash flow. 2023 down to 4.8 billion. 2024 down again to 806 million. Trailing 12 months looks like it's down again unless they really have a bang up last quarter of the year here, or last 4 months of the year, 385 million. So as you can see, steady decrease in free cash flow, negative 385 million. That's, continuing the trend. Repurchase of capital shares, 2.7 billion, 2023, 1.5 billion, 2024, 2.2, trailing 12 months, 1.2. So they are pulling shares out of the market. We'll see here at the end if they are pulling more shares out of the market than they're adding. Jumping over to stockanalysis.com, just like Yahoo Finance, this is one of a couple sources that I look at. Actually, there's a couple other ones as well if I need to. And I do recommend more than one source, 2, if not 3 sources, so you can make sure the information you are looking at is accurate and up to date. And whenever you see a discrepancy between the 2 sources, that's whenever I go to a third source. So again, 2, if not 3 sources is what I recommend. Now, 7 analysts have taken a look at this. They do call it a strong buy. Low estimate of $145. It's currently lower than that. So if it came back up to their low estimate, that would be a 0.63% increase. Average estimate of $157.43. That's pretty close to what we saw with Yahoo Finance on the previous page. That would represent a 9.26% increase. High estimate of $170, which would still be lower than their 52-week high, would represent a potential 17.98% increase. I like to look at some statistics. Return on capital employed is the one. 7.13% is lower than the 10% or better that I like to start with. EPS growth was not listed, so can't look at that, and revenue growth wasn't as well. Quarterly pay, as we mentioned, payout ratio 39.65%. So again, in the under 40% range, well under the 75% or lower I look for. Dividend growth 2.82%, which typical years would beat inflation. We might be a little hotter than that right now, but really 3% or better dividend growth is what you'd want, unless it has a high dividend payout, 5-6%. Then I could go with something a little lower. But this one doesn't have a high dividend payout, and it also has slow growth, so not a good combination in my mind. Does have growth of 52 years. Buyback yield is positive, so they are pulling more shares out of the market than they are issuing. Shareholder yield positive as well at 6.13%. Now, they do pay off schedule than most companies, February, May, August, November timeframe, so that is nice if you're trying to balance out your payouts to every month without having monthly payers. Going back to December 2022, 51 cents. December 2023, they were paying 54 cents per share, raised it up December 2024 to 55 cents. And I'm assuming if they're going to continue this raise, which with the payout ratio in the 40% range, in December, you will see another raise to that dividend. All right, let's run through the screener and wrap this one up. Understand the business. Yes, they're a steel company, right? They're providing steel for other manufacturers, businesses, car companies, construction companies, that sort of thing. Growing free cash flow? No, it's been negative free cash flow for the last at least 4 years. Growing dividend? Yes, almost 3%, not quite 3%. Dividend payout ratio is under 75%, so check there, and that is about it. Dividend yield theory says they're overvalued. No check there. It is not within 15% of a 52-week low. No check there. Return on capital employed is lower than 10%. No check there. Earnings per share growth is under 5%, or I'm sorry, it wasn't listed. So that indeed could be a check, but even if it was, let's just give them that one. Let's say if it was over 5%, that would still only be 5 of 8 and not make it on my watch list. I will say several of the companies I have looked at so far that Buffett added to his portfolio would not even make it through my screener. Now, I'm not as smart as Buffett. He definitely has UNH is the exception so far. He has a team, a much bigger team, and knows far more than I do, insiders and people he could talk to than I do. So maybe he knows something about this one that I don't, and maybe you want to take a look at it anyway. But for me, it is not one on my watch list. It is not one that I'm probably going to add to my watch list. And with that free cash flow declining the way it was over the last several years, has me concerned. Though, like I said, with a free cash flow and a free payout ratio as low as it is, I don't think they're in danger of a dividend cut, and it looks like they're maintaining that dividend growth. So again, if it's one you want to bet on for the future and you believe in tariffs making the steel company great again, so to speak, more power to you. But it's one, like I said, for most of my adult life, I've heard about tariffs being used to bring back this, and that's not just under Trump. That was under Biden, that was under Obama before him, that was under Bush before him, that was under Clinton before him, the other Bush before him, Reagan, going all the way back. They've been talking about, like I said, as long as I can remember, and I was born in 1979, grew up in the 80s and 90s. hearing about steel tariffs were going to bring back steel manufacturing. And I grew up in the Rust Belt in Michigan, and we have watched steel manufacturers continually decline. As a matter of fact, there's empty steel plants along the Detroit River as we speak right now, and I know there are in Pittsburgh and other states along the river as well. So I'll be convinced that they're going to bring steel manufacturing back to America whenever they actually prove they can do it, and tariffs will have a different effect this time than they have in the past. All right, I'm going to get off my soapbox there. Didn't mean to get into politics, but there is some politics around this one, I think. And maybe that's the reason. Maybe a 50% tariff will do the trick when all the other tariffs over the decades have not. Who knows? Well, let me know what you think of Nucor Steel in the comment section down below. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Drop a comment down below. Again, let me know what you think of the video. Let me know what you think of Nucor Steel. Is it one Nucor Steel? Is it one you're buying? Is it one you're selling? Is it one maybe you're holding for more of a pullback? I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend. We will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount you are not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria. Always seek the advice and counsel of a certified financial advisor. For those of you who made it to the end, thank you for watching to the end. Watch time is one of the metrics that the YouTube algorithm looks at, as well as making sure you're subscribed and clicking all those buttons down below, and share with anyone you think that might find value as well. That helps out too.